Hi, everyone. Hi, April. I don't know if you wanted to start just to say something to the attendees, and then I can go from there.
I just, this is an odd platform because I can't see who is here, but welcome. I'm glad that you guys all decided to join today. I assume that the majority of them are my agents and clients and friends, and I think that this is one of those things that in an ever-changing market, it's really important to know, things like this, outside the box thinking, deal structuring that's new and inventive and stuff like that. So I think it's a huge help, and I thank you guys so much for coming on and doing this for us.
Of course. April, thank you so much. We appreciate the opportunity. I'm just going to mute my phone here to make sure that doesn't interrupt me while I proceed. So in this presentation, we're going to discuss what is a 1031 exchange, how to successfully execute an exchange, and then why would someone choose to do an exchange. My name is Lauren Speidel. I'm the Regional Manager for Exeter 1031 Exchange Services. We are a nationwide qualified intermediary, and we'll get into this in a bit more detail, but when you're doing a 1031 exchange, you need to hire a qualified intermediary to prepare the documents, help advise, help structure the exchange, and so that is where we come in. Before we get going, I do want to let you know that there should be an area on your webinar where you can chat, and I think we may be able to open up for audio later in case people have questions. But I'll just start off with kind of the basic. Let me make sure that this is working for me. Give me 1 second. My computer's a little slow today. Going to the next slide, so give me just 1 second. There we go. So of course, when you're discussing 1031 exchanges, it is extremely important to know what a 1031 exchange is. And a 1031 exchange is something within the IRS code that allows you to take property that you have held for rental income, appreciation, or use in a trade or business, sell that property, defer the tax liability associated with that sale, and have your full net sales price working for you in another property. Again, held for rental income, appreciation, or use in a trade or business. So typically your primary residence won't qualify for exchange treatment. And 1031 exchanges have been around for hundreds of years. Before it was actually a code within the IRS, which actually was in 1921. Farmers would barter for livestock, they'd barter for land and equipment quite frequently. And then in 1921 is when it actually became a code in the IRS. And for the most part, 1031 exchanges were all done on the same day, the same closing. You would sell a property and you would buy a replacement within minutes of one another. And that really remained unchanged until the 1980s, 1990s, where we started to see some changes with Section 1031. You may also hear 1031 exchanges be called Starkers, and that actually is from T.J. Starker. T.J. Starker was a timberland owner in the Pacific Northwest, and he had a paper mill company come to him, Crown Zellerbach, and say, we want to purchase your property. So they gave him units for his property, and he decided to do a 1031 exchange with those units. One of the reasons why he did not take cash is because once you do take cash, it is considered taxable to the IRS. So you cannot take receipt of the funds, and this is where a qualified intermediary comes in. But he did take units for the sale, and Crown Zellerbach would provide possible replacement options, and he would trade in his units when he decided to purchase one of those. And this happened over a 5-year period. Eventually, he used all of his units. And at that point then, he filed his exchange with the IRS. The IRS audited him, told him that he did not complete the exchange according to their parameters, and he paid the tax, but took the IRS to court for 4 years and eventually won. And that's really where you saw the timelines to complete an exchange change. Instead of having 5 years to complete an exchange, you have a total of 180 calendar days. You really have to understand those rules and requirements before engaging in an exchange, because again, your time is limited. Now, the next question typically is, why would you complete a 1031 exchange? And let's just wait for my slide here to catch up with my, there we go. So when you are selling your primary residence, one of the benefits of owning a primary residence is that when you sell it, you typically have an exclusion off of that gain. If you're single, it's $250,000 of gain is excluded from your income. If you're married, it's $500,000. So that's certainly a benefit of owning a primary residence. But when you have an investment property, there's a significant amount of tax liability that may occur. Usually what we see from our clients is somewhere between 30 to 40% in taxes off of the gain. So you typically have your capital gains tax of 15 to 20%. You have state tax possibly. Medicare surcharge is at 3.8%. That's also called the Obamacare tax. And that is triggered usually when your income's above 200 to 250. So taking proceeds from a sale could kick you above that amount if you weren't already there. And then the biggest is depreciation recapture at 25%. We often hear clients say, well, I didn't depreciate the property, so I don't have to pay that back. Unfortunately, you do. It's always advised that you depreciate your assets so that you do get a tax benefit every year. Because when you do sell it, you are going to be responsible for 25% of what you should have taken back to the IRS. So that is extremely important. It's also important to note that when you purchase a property, that is your original cost basis. But over time, that cost basis number changes. It may increase due to improvements that you make. It may decrease due to the depreciation. And then when you look at those numbers, that would be your adjusted cost basis. That would be the number that has been affected by improvements and depreciation. And that number is important because when you're selling an asset, the IRS or your CPA, your tax advisor, is going to determine your gain off of that adjusted cost basis number versus what you sell that asset for. So a lot of times I hear people say, well, I bought the property for $200,000, I'm selling it for $250,000, so my gain is $50,000. That's not necessarily true. If you've depreciated it, let's say by $50,000 while you've owned the asset, your adjusted cost basis would be $150,000. And if you have a net sales price of $250,000, the gain is actually $100,000. So it's really important that you know what that number is when you're selling your property, so you can really figure out what your tax liability may be. If you do not have a tax advisor or a CPA, it's always advised that you use one because they are really instrumental in making sure that they determine what your gain is, what your tax liability is, and whether it financially makes sense to do a 1031 exchange. Now, the biggest benefit of the exchange is the tax deferral. Now, keep in mind this is tax-free. You can do as many exchanges as you want throughout your lifetime. You can defer as much tax as you possibly can, as long as you fit the rules and requirements for an exchange. So you can really build your wealth through real estate much quicker, as opposed to selling, paying the tax, buying another property, selling and paying the tax. For example, if your tax liability is, if your tax liability is $50,000 and you do a 1031 exchange, you're not paying that $50,000, so you're able to buy a property that's $50,000 or more in value. So it can really help build your wealth through real estate. The biggest benefit is the really exchanging throughout your lifetime, keeping that wealth in your family. And that basically means that once you pass away, your beneficiaries receive a step up in basis. So let's say, for example, I had a property and I had $200,000 of tax liability or $200,000 of gain, and I passed away. My son would then hire an appraiser to come out to value that asset. If the value of that property, let's say, is $500,000 and he sells it thereafter for $500,000, he's not going to have any tax liability because the depreciation recapture and the tax liability goes with me when I pass. So if he sells it for $500,000, he's going to get that step up in basis, and he is not paying tax liability on that sale of the property. So it is a huge benefit to the exchange. It's also important to note that there was a 30-year study done that showed that 88% of people who do 1031 exchanges eventually sell and pay the tax. And I think that comes down to not having enough education. There are certainly options for taxpayers if they don't want to actively manage real estate. And we'll get into that when we talk about Likekind Property. But if you are in that boat where you are getting older and you don't want to deal with what we call the 3 T's, tenants, trash, and taxes, there are passive investments that you can roll your proceeds into that would be considered exchangeable. And we'll get into that in just a few slides. Now, to complete a 1031 exchange, let's let my slideshow to catch up with me. There we go. In order to successfully complete an exchange, there's a few things that a client has to be aware of. One, when we're talking about exchanges, you'll hear the word relinquished property a lot, and you'll hear the word replacement property a lot. So the property you're selling is the relinquished property, and the property that you're purchasing is the replacement property. You could be selling 5 relinquished properties and be buying 1 larger replacement. You could be selling 1 larger relinquished property and be buying 5 replacements. So the number of properties doesn't matter. Again, intent and having the intent to hold it for rental income, appreciation, use in a trade or a business is definitely critical. And timing is critical when you have multiple properties. To get started for an exchange, usually we say the best time to involve a qualified intermediary is once you have a signed contract or an estimated closing date. It's always advised that you reach out to your tax advisor again, first determine if the exchange makes sense for you to complete. And then from there, you'll want to get in touch with a QI or an accommodator. We're all the same thing. We must be assigned into the contract before closing. We need to set up your exchange account before you close, coordinate the exchange with the closing agent. We're going to draft the necessary exchange documents for you and the closing agent. We're going to help advise, help structure. We're going to keep track of your deadline dates, which we'll get into in just a few slides. And we're also going to hold the proceeds. Like I stated earlier, you cannot take receipt of the funds. So it's important that you hire that QI before closing. We get a lot of phone calls. We're actually available 24/7. One of the big reasons is that a lot of these deadline dates are calendar days. So if we have a client that has an emergency or has questions late at night or on the weekend, you're not going to get an answering service if you call our 800 number. You're actually going to get one of the employees that work for Exeter. And we get a lot of phone calls where someone has said, well, I just closed yesterday and I want to do a 1031 exchange, or I just closed a couple hours ago. I'm holding the check in my hand and I want to do a 1031. How do I get that started? And unfortunately, we have to be the bearer of bad news to explain to them, if you already closed, you have missed the opportunity to do the 1031 exchange. So it's advised, again, that you hire that qualified intermediary before closing so we can draft those documents, set up your exchange account. The settlement statement's going to show us receiving the funds. So these are all really important when you're executing your exchange. Now, like I stated earlier, the qualified use requirement, I would say, is one of the most critical requirements. And that is that you must have the intent to hold both the relinquished and replacement property for rental income, appreciation, or use in a trade or business. Typically, commercial property might fall under that. Property held for sale will typically not qualify for exchange treatment. For example, if you have purchased a fix and flip, you've put, let's say, $50,000 in and now you want to sell it, your intent is to sell, it's not to hold. So it doesn't qualify for exchange treatment. If your intent changes, which can certainly be the case, let's say, for example, you do a fix and flip and you have the intent to sell that asset, but you decide, you know what, I think it's better for me to hold on to it right now and rent it. And you rent it for a year or two, now it qualifies for exchange treatment. So keep in mind, intent can certainly change. Condo conversions and property acquired to develop typically doesn't qualify. For example, if you're a developer, your property is actually considered inventory to the IRS. So it is part of your business and it does not qualify for exchange treatment. And this kind of just reiterates what I said. Again, you must have that intent to hold. There is no specific holding periods. So we often get calls where clients might say, well, I've owned it for 2 years, does it qualify? Most 1031 exchange experts will recommend holding that asset anywhere between 12 to 24 months because it's going to straddle 2 or 3 tax years. So if you're audited, you can easily prove that you had the intent to hold that asset because that's exactly what you did. We had a client actually that ended up buying a replacement property in Florida, a condo. He did not read the CC&Rs, didn't realize he couldn't rent the property. Once he found that out, he immediately put the property back up for sale. He sold it, did another exchange, and found the property that he wanted to buy as a replacement that he could rent. Because he was on title for less than 45 days, that triggered an audit, just ends up causing a red flag. And because of that, he explained to the IRS, listen, I had the intent to rent it. I didn't do my homework. I didn't read the CC&Rs. I found out I couldn't rent it. I immediately tried to fix the situation. And the IRS actually gave him a pass. So again, it's extremely important that you do have the intent to hold that asset. Within Section 1031, there is no specific or required holding period. So keep in mind, things can happen. I had a client who ended up buying a replacement property with the intent to fix it up and rent it. He had documentation to prove that because he had emails to his real estate broker explaining, listen, this is what I'm looking for. And then every time he uncovered something, it was always more expensive than he thought. And he ended up going through his entire savings. And he said, you know what, I'm done with this property. I just want to buy a property that I can rent, a turnkey property. So he sold it, he did an exchange, and he bought a property that he could do that with. He was not entitled for very long so far. He has not reached out to tell me if he's going through an audit, but again, he has documentation to prove his intent, which would support him in case of audit. Now, the Likekind requirement. You may also hear 1031 exchanges be called Likekind exchanges, and that basically just comes from this requirement. And keep in mind, Likekind is very broad. Any type of real estate is Likekind to any other type of real estate as long as the qualified use requirement is met. So again, holding that property for rental income, appreciation, or use in a trade or business. We often get calls saying, well, I'm selling a multifamily, so I have got to buy a multifamily. That's correct, right? And it's not. I think that comes, that kind of circles back to personal property exchanges. Personal property exchanges are artwork, collectibles, fleets of cars, planes, things that are considered personal property. Those were eliminated in 2017 with the new Tax Reform Act. So they are no longer valid. With those types of exchanges, it had to be very specific. So if you were selling artwork, you had to purchase artwork. Again, with real estate, as long as it's real property, it qualifies. So here is a sample of Likekind Properties. A single family home qualifies, multifamily, commercial office, retail, industrial, vacant land, some lesser known oil and gas interests, mineral interests. We see those a lot in Texas and the Dakotas. Air and water rights we typically see in big cities. And fractional ownership, so syndicated tenant in common or Delaware statutory trusts, TICs or DSTs. It's important to note that these are options for someone that maybe doesn't want to actively manage real estate any longer. With these types of portfolios, you have a nationwide real estate sponsor or real estate company that puts together a portfolio, and you can reinvest your equity into the portfolio. And so you literally own a percentage of the portfolio. They range in sector. They could be anywhere from multifamily, healthcare, industrial, commercial, grocery anchored. The list really goes on and on. You typically get monthly income, I would say at this point, anywhere between 4 to 6% on average. It is a very illiquid investment. So usual hold time is anywhere between, I would say, 5 to 7 years. But it certainly can be an option for, again, individuals that don't want to pay the tax, first of all, so they want to complete an exchange. They also, don't want to actively manage a piece of property or actively manage that real estate. this can certainly be an option. They would purchase this through a financial advisor. If ever you want to explore this further, definitely feel free to give me a call. We can certainly chat about it in more detail. It is a security, so there are certainly some risks involved with that type of investment. Non-Likekind properties. So as I stated earlier, primary residence typically doesn't qualify because you have that primary residence exclusion. Second homes and vacation homes typically don't, but they can with proper planning, which is the next slide. Property held for sale. So again, conversions, developments, fix and flips. Your intent really is to sell, so it doesn't qualify under that intent to hold requirement. Securities, so cash, of course, is not real estate. Stocks and bonds are not real estate. Mutual funds and REITs. REITs are often an area that's misunderstood. With a real estate investment trust, you own shares. You actually don't own real estate. That's why it's not considered real property. Interest in equity, so partnership and membership interests, LLC interests, or shares in a corporation. And that basically states that those types of organizations, entities can do an exchange, but you cannot sell real property and buy into an LLC or buy into a corporation, because in that situation, it's membership interest or shares in a corporation. It is not real property. So if ever you have a question about that, partnerships, corporations can get really sticky. So in case you do have a situation where you or a client of yours is in a partnership or an LLC, corporation, trust, something to that nature, definitely give us a call. We can kind of walk through those requirements, make sure it fits those guidelines. Now, vacation property and second homes. IRS saw a lot of taxpayers doing 1031 exchanges with these types of properties, and they said, wait a second, you have to fit these safe harbor guidelines in order to qualify for exchange treatment. One is that you must own the property for at least 2 years before you sell and do a subsequent exchange. That property must be rented for at least 14 days out of each year. And your personal use must be limited to 14 days or 10% of days rented, whichever is greater. So if you only rented it for 14 days out of each year, you can use it for 14 days personally. If you rent it for 300 days out of each year, you can use it for 30 days out of each year personally. So those individuals that have a vacation home or second home and all summer long they're using it, it typically won't qualify because it's not going to fit these safe harbor guidelines. If you have a situation like that, I think it's really important to have a conversation with your tax advisor and your qualified intermediary to make sure that it does fit those parameters. But also, if you own one of these properties, it's always good to have this information before you start considering a sale. So if you work with any clients that own vacation homes or second homes, it's always good to possibly share this knowledge with them in case they decide to sell in the next few years. Now, the reinvestment requirement is definitely a requirement that is often misunderstood. It's important to note that when you are selling that property and you're buying a replacement, to have a fully tax-deferred exchange, you need to trade equal or up in value based on the net sales price of the property you sold. You have to reinvest all of your equity and you need to reinvest all of your debt value. And so the next slide is going to give us an example. Let's say, for example, you have a property that you're selling for $540. After you pull out permissible closing costs, let's say and permissible closing costs would be broker's commission, routine closing costs like title insurance, closing agent fees, real estate attorney fees, document filing fees. You then net in this situation, let's say $500,000. That is your net sales price. Keep in mind, I did not deduct debt. So at closing, the closing agent's going to pay off that mortgage that's tied to the property. In this example, let's say it's $250,000. That's paid off. What's left is another $250,000 that goes to your qualified intermediary. To have a fully tax-deferred exchange, you need to reinvest the entire $250,000 that the QI is holding, and then you need to take out another mortgage for $250,000 or offset it with cash. So if you don't want to take out a mortgage, you don't have to. You could bring another $250,000 to closing. What's important is that you purchase a replacement property or multiple replacement properties that total $500,000 or more in value. Now, an example of, let me step back. You can do a partial exchange. So a partial exchange is if you do not reinvest all of your cash or you don't reinvest all of your debt and you trade down in value. Many times we have clients that say, you know, I want to take out $20,000 at closing, and that's perfectly fine. You certainly can choose to do so. If you do, it would have tax liability because the IRS taxes your gain first. So even if you and I believe that's your equity, the IRS doesn't believe that it is. They want their portion of any part that is not reinvested. So pulling cash out will cause some tax liability. Trading down in value. So for example, let's say same scenario, you net 500, you buy a property for 475. That $25,000 difference from the 500 to 475 would have tax liability. So it's not going to trigger all of your tax liability, but a portion of it. Whenever someone is doing a partial exchange, it's really important that they check with their tax advisor to determine if it still makes sense to do the exchange. And I say that because earlier in the presentation, I mentioned adjusted cost basis. If you do not reinvest above that adjusted basis amount, you're not deferring any tax liability. Your full gain is not being reinvested. So that's why it's really important you do check with your tax advisor to make sure it still makes sense. Now, the next slide is going to give you examples of permissible and non-permissible selling expenses. The left side is, just common routine expenses that come up in a closing. Our fees, as you can see, fall underneath that line item. Our fees are $899. That covers the sale of one property and the purchase of one replacement. Any additional replacements would be another $300 per closing. You can use your proceeds to pay for our fee. That's why it's considered permissible. So once the funds come to us, that is when our fee is deducted. It's deducted from the proceeds that we've received. You'll see on the non-permissible side, financing or lender costs, prorated property taxes come up quite a bit, prorated rents, insurance premium payments, security deposits, any sort of payoff of credit card balances, repairs or maintenance costs, all considered non-permissible. So that means that you can use your proceeds to pay for those expenses, but that amount would have tax liability. So before you go to closing, it's always important, take your settlement statement, review it with your CPA or tax advisor. That way you at least know what your tax liability may be next year if there are some non-permissible expenses on there, or you can choose to bring out-of-pocket funds to closing to cover those expenses so you have that fully tax deferred exchange. On the side of the webinar, there's an area that has handouts under where kind of audio is. And underneath the handouts, you will see a guide to 1031 exchanges. On page 20, it's a PDF version. On page 20 of that guide is a list of these in case you wanted to view them. And I can always send a copy of this to April after the presentation's over. The tax-paying entity requirement. This is definitely a critical component to the exchange. It basically states that the IRS does not care about the beautiful name that our mothers gave us. They care about our Social Security number. So the Social Security number that is selling the relinquished property is the one doing the exchange. So it must be the Social Security number attached to the replacement property as well so that you finish your exchange. There are a couple exceptions to this rule. A single member LLC and a fully revocable grantor trust, which are typically both disregarded entities, are considered the same as yourself. It's not filing its own tax return, it's flowing through to your personal tax return. So you could sell in your single member LLC as long as it's a disregarded entity, and you could buy in your name without an issue, and vice versa. Same thing with the fully revocable grantor trust. Again, check with your tax advisor to make sure that they are structured as disregarded entities before you end up, changing the entity structure, just to make sure that you're fully compliant with the exchange. Now, the total exchange period is definitely a part that has some confusion that a lot of people are concerned about. So I'm going to walk you through this here. When your relinquished property sells, let's say, for example, today was your closing. The next day, so May 20th, would start your exchange period. You have 45 calendar days to identify possible replacement properties, and then you have another 135 calendar days to close on something that you identified on your identification form, for a total of 180 calendar days. So keep in mind, it's not 45 plus 180, it's a total of 180. It's also calendar days. So if your 45th day ends on a Saturday or on a holiday, we still need that identification form back by that date. Again, it begins at the close of the sale transaction, and there are, and I'm saying typically, no extensions. For example, we don't normally see individual taxpayers receiving extensions. But with that being said, we are currently in an extension due to COVID-19. So we will discuss that in just a few slides, what that extension entails. It's also important to note that if you have a transaction in the latter part of the year, let's say, for example, October 17th, anytime you have a closing between October 17th and December 31st, your 180th calendar day is going to go past April 15th, which is typically the deadline to file your taxes. If your sale, let's say, takes place in 2020, you have to report that exchange on your 2020 tax return. So it's important that you either buy your replacement property and finish your exchange and then file your taxes, or if you're going to need the full 180 calendar days, file an extension, then file your taxes, or then complete your exchange, then file your taxes, so that you can properly report that exchange and the replacement on your 2020 taxes. It would be Form 8824 that you would need to complete and submit with your tax return. Now, when you're identifying, the qualified intermediary is going to give you a form to complete. This is the form that you need to submit by your 45th calendar day. Keep in mind that when you're within your 45 calendar days, you can change your mind as many times as you want. But once you pass your 45th calendar day, you cannot amend your form again. So you want to have a really good idea of possible replacement properties before your 45th calendar day ends. When you're identifying on our form, it's going to ask you, how are you identifying? And here are the three options. The most common, I would say 90% of our clients use the 3 property rule. It allows you to identify 3 possible replacement properties regardless of value. So you're going to give us an address of each of these properties. You could identify 1 if you want. You could identify 2. You could identify 3. You don't need to close on all of them. You don't need to have a contract in place. If you do, you're definitely one step ahead. But in this situation, you're just identifying 3. Or if you don't want to use the 3 property rule, you can use the 200% of gross sales price rule, which basically states that you can identify double what you sold for. So if you sell, let's say, for $500,000, you can identify $1 million worth of real estate. In this situation, you cannot go above $1 million. If you go above $1 million, you're going to have an issue with your identification form. You're probably going to get a call from one of our exchange administrators saying you're not fitting into that parameter. With the 200% rule, you also need to give a fair market value on every one of those properties. So it's definitely a little bit more detailed. You certainly have to know what you sold for to accurately provide the identification form back to us. Now, if you want to identify a number of replacement properties, you can choose the 95% exception, which is the least commonly used. And that is because with the 95% exception, you have to close on 95% of what you've identified. So for example, let's say you identify 10 properties, you've got to close on 10 properties. If you are able to close on your replacements all within your 45 calendar days, then this option can certainly work for you because you can close on those replacements and then identify, and you know that you're going to fit the 95% exception because you've purchased everything within your 45 calendar days. Keep in mind that when you identify, again, you don't need to be under contract, but you must be as clear as possible. So a street address, a legal description, a parcel number. You know, you can't just say a condo in Mainville, USA. You've got to actually have an address in mind. Now, what I just discussed was the forward exchange. The forward exchange is when you are selling a property and then you are taking some time to buy the replacement. Keep in mind that there is something called a simultaneous or concurrent exchange, which is exactly what occurred before TJ Starker helped change the rules of 1031 exchange timeframes. You would sit down at a closing table, you would sell your relinquished property, and within minutes or hours, you would buy the replacement property. We certainly have clients that still do those types of transactions. Keep in mind, you still need a qualified intermediary to prepare those exchange documents, and you still need them to kind of direct where the funds are going. The delayed exchange involves that 45-day identification period and that 135 days to close, so the total of 180 days. And again, it's where you sell first, you buy second. There are also some more complicated transactions. A reverse 1031 exchange is great for someone who is really concerned about those timeframes, or maybe has found their replacement property and they don't want to miss the opportunity. They don't want to wait for their relinquished property to sell. With reverse 1031 exchange, we are actually being assigned into the contract before closing. We're going to set up an exchange accommodation title holder agreement where we actually purchase the replacement property on your behalf. We park title to it. Within your 45 days, you're identifying what you're selling, and then you have another 135 days to get it sold. So you're buying first, you're selling second. These transactions are, again, much more complicated, so the expense is going to increase. With a reverse exchange, I would say some of the biggest hurdles we have found has been financing. If you don't have the out-of-pocket funds to purchase that replacement property, you're going to need an outside source like a lender. Most lenders, especially some of your larger lenders, don't understand reverse exchange. They don't lend to LLCs, and LLC is involved with the transaction. So again, that's probably one of your biggest hurdles. There are also build-to-suits, improvement, or construction exchanges, and that's where you are buying a replacement property. We actually would buy it on your behalf, park title to it. Within your 45 days, you're identifying that asset, you're identifying those capital improvements you want to make. You're also identifying contractor costs. The client or the exchanger would be named the construction manager, and then they would make those improvements. You'd have to get as much completed as possible within your 180 calendar days. And then towards the tail end of your transaction, get an appraiser out there to verify what's been constructed. Again, a lot more moving parts. It's going to definitely increase in price. And we certainly want to have a conversation with our possible clients on any of these more complicated transactions before they set it up to make sure they understand the rules and requirements. We also are one of probably 4 or 5 companies in the United States that do foreign property 1031 exchanges. The difference with foreign property is foreign property. Foreign property is like kind to other foreign property. So you couldn't be selling in Mexico and be buying in the United States. You'd have to buy another foreign property. So we've done a number of these. It's always important, again, to have that conversation with the client before engaging in a foreign property exchange. There could be language barriers, contract barriers, just barriers in general in how to, how to receive funds. Some countries don't allow it. So we definitely want to have that conversation before anyone engages in that. Now, this is a question that we get often, I would say. You can certainly use 1031 exchanges for future tax planning. In this situation, and there's kind of 2 here, you could take a rental property and convert it to a primary residence. So let's say, for example, you buy a replacement property in Florida with the intent to eventually retire and make that your primary residence. You certainly can do so. First of all, I would advise that you don't put anything in writing that this is what you're going to do, because you don't want, heaven forbid, you get audited and they can audit your emails and you clearly state, I have the intent to make this a primary residence in the future. Clearly your intent is not to hold, it's not to use it for investment purposes, it's to eventually use it as a primary residence. So I would be mindful of that. Certainly a whole nother situation when you're just gathering information. In this situation, you would move the renters out. You would live there for at least 24 months. And now it is a prorated exclusion. The proration is based on the number of years the property was used as a rental versus number of years as a primary. But before you're able to qualify for that exclusion, you must own that property for at least 5 years. So in an example, let's say it was a prior replacement property, you rented it for 3 years, you move those renters out, you move there and you live there for 3 years. Now you fit the 5-year owning period, so you now qualify for the exclusion. If your gain, let's say, is $100,000, it's going to be split in half because your rental time was 3 years, your primary residence time was 3 years. So 50,000 would be taxable, 50,000 would fall under that exclusion. So it can be a great option for someone. Again, proper planning is needed, and it's certainly advised that you check with your tax advisor to make sure you know your proration amounts. And the longer you live there as a primary residence, the more benefit you will receive. You could also have a primary residence and convert it to a rental property. So let's say, for example, you own an asset and you decide to move out and you convert that into a rental property. This really works if your gain exceeds that primary residence exclusion. So let's say, for example, your gain on your primary residence is, I don't know, 600,000. You could move out, rent it for 2 years, sell within that 3rd year. So you still fit that primary residence exclusion of living there for 24 out of 60 months. And now again, you'll get a prorated exclusion. That sale must take place no later than 3 years from the date that you moved out. To give you an example, we had a client in California who bought a property, 30, 35 years ago for $300,000 on the beach. And they were getting ready to sell. They got an appraiser out there and they said, your property is worth $8 million, which is a wonderful problem to have. So what they did was they moved out, they rented it for 2 years. Within that 3rd year, they sold it. They received $500,000 of the exclusion. So they were able to get the full amount. And then anything above that, they did an exchange with and bought rental property on the East Coast. So they were able to do an exchange for about $7.5 million. So again, proper planning is needed. Always make sure that you're having that discussion with your tax advisor to make sure you qualify for these. Now, earlier in the presentation, I mentioned the extensions, that typically a taxpayer doesn't qualify for extensions. We've never seen the IRS give one, but currently we're in an extension, and that's due to COVID-19. And the extension was granted on April 9th for any person performing a time-sensitive action, and that includes 1031 exchanges. So if you were in your 45th calendar day or your 180th calendar day within April 1st to July 15th, you received an extension to July 15th. So for example, let's say your 45th calendar day fell on April 1st. Now you have until July 15th to identify. If your 180th calendar day, so you needed to close on your replacement by April 1st, that also was extended to July 15th. So now that we're nearing the end of May, closings that are occurring in the beginning of June may not benefit from this extension unless, of course, an additional extension is granted. Towards July 15th, the IRS could always issue an additional extension, but I would definitely not hang your hat on that because we don't have any verification. It's also important to note that in the past, when 1031 exchanges receive extensions, it's been very different from what we currently have been given with this extension. In the past, the president would first designate an area a natural disaster area. One thing right there, COVID-19 is not considered a natural disaster. So it differentiates right there. But also, it's then granted by county. It's granted by dates. You can specifically look at a natural disaster and be able to say what counties were affected, what dates were affected. In this situation, it's very different. This is a nationwide extension, first of all. It's not a natural disaster. And can we really say when it started affecting people? So there's definitely been some concerns and disagreements on the April 1st being the beginning date, when a lot of states entered lockdown much earlier than that. And some individuals were affected, even in February. So right now we are waiting for some FAQs. We expected the IRS to release these FAQs already, and they have not. So we continue to watch for those FAQs to be released. I will certainly notify April once they are released in case she wants to share that with all of you. But that's currently the extension that we are under. Now, it's important to note that when you're interviewing, and you should interview qualified intermediaries, I think that it's really important that you know that our industry is completely unregulated. So anyone can be a qualified intermediary. And with that, there certainly have been issues. We have seen, certain companies file for bankruptcy in the middle of an exchange. We have seen some companies mishandle funds, write out steal funds. So it's extremely important that you do know what protections that you or your clients have in place. We have extensive experience and expertise. We've been around since 2014. 2004, my apologies there. Errors and emissions insurance, we carry $5 million. We carry $5 million fidelity bond protection. We also can provide insurance binders if any of our clients want to call to verify coverage. We also are audited, licensed, and regulated by the Wyoming Division of Banking, which I think is extremely important. We went through the regulatory process over the past 2 to 3 years to be regulated. So every 18 months, we are going through an audit. We have significant capital equity reserves, and we also hold funds in a separate and segregated dual signature qualified trust account. Now, to give you a little bit of background on the safeguards we have in place and why. The good companies have gone to the Department of Treasury and said, please regulate us, because there have been a lot of bad apples out there. And they said that the cost exceeds the risk to the client. So they basically don't want to pay to regulate qualified intermediaries. With that, we've seen a handful of situations. If anyone is familiar with MSNBC, there's a show on there called American Greed. Ed Oken was a gentleman out of Florida who started his own qualified intermediary business and started to acquire other QIs. Eventually, somebody blew the whistle on him, and he was using clients' funds to buy yachts, mansions. He bought his wife a hair salon, so she never had to wait for a hair appointment. He is now spending 100 years in prison. He stole $120 million from his clients. There also was a very large title company, the second or third largest title company in the United States. And what they did was in 2008, they took client funds and they invested them into auction rate securities. Auction rate securities are typically very secure securities, but they also provide the QI with a higher interest rate, which is why they decided to place the funds there. And you should not have your QI investing your funds anywhere. They should be in a money market type account so that they're liquid when you need it, and they're not, they're not going to be in a risky account just for a higher interest rate. In this situation, what happened was in 2008, those auction rate securities were not liquid. They lost a significant amount of funds. The title company, the larger title company that was connected to the QI, started moving funds around within the organization, and it actually ended up taking the entire title company down. When they filed for bankruptcy, the judge ruled that the funds were not held in a qualified trust or qualified escrow account. So those individuals that were completing an exchange, they were creditors like everyone else. So not only did they lose the funds that they needed to complete their exchange, they also were due the tax then the following year because they didn't finish their exchange. I'm not sure if anyone is familiar with the website Bigger Pockets, but there was a gentleman on there who I was competing for business. A client called up and said, well, he's offering an account for $500, and it just wasn't something that we could accommodate. I explained to him the safeguards we have in place, and he ultimately chose to choose us. A few months later, there's a Bigger Pockets thread about this QI where people could not reach him. They were going to his office was closed. About a month later, they found him with his Ford Mustang on fire in the back of a commercial building. He burned about 90% of his body, lost both his hands, was in a coma for 8 months. And you say, oh my goodness, this is horrible news. except the FBI had started investigating him a few months beforehand, and they believe that he started this fire himself to distract from this investigation. And his argument for the fact that he, basically stole $7 to $8 million was that I've been in a coma for 8 months, so of course I couldn't release funds. Currently, he's still under investigation, and so we don't know yet what the final verdict is on that, but that just gives you an idea of how far people will go in a situation like this. So definitely make sure that, again, the company is reputable, they have insurance and bonding, that they are regulated, and that they do hold your funds in a qualified trust or qualified escrow account. And then this next page just gives you a short synopsis on our company. Again, we're a qualified intermediary, also known as an accommodator. We can also act as an exchange accommodation title holder, which allows us to do those more complicated transactions, reverse improvement. We can do them in all 50 states, including foreign property. We are available 24/7. Our website's right there in case you want to get any additional information. We've got a lot of information on our website. And then the next page will have my contact information. That's my direct line. Feel free to call if ever you've got questions, concerns, want to kind of go through a certain structure. That's my email address again, if you'd like to email me, and then that's my website. From there, I'll kind of open it up to questions. Again, there's a chat feature in case you want to